everyone. My name is Hripko with Royal LePage, and today I am joined by the lovely Cheryl Sanguinetti. Cheryl is the founder and mortgage broker with the Mortgage Gallery with Invis, working in Calgary and area, and has over 20 years of experience in real estate, private financing, marketing, and administration. She is a wealth of knowledge and provides my clients with incredible information and guidance to ensure that they make the best decision possible for their situation. So today we're going to have a quick chat to go over what is happening with these recent interest rate increases and briefly cover some other questions that I have. So first off, Cheryl, how are you doing today?
I'm great. Thanks, Alex. Thanks for having me.
No problem. So let's get into some of that content here. So with that recent increase in the interest rates, I'm sure many buyers and sellers are concerned with what this means for them. So could you maybe shed some light on what your thoughts are on the interest rate increases and how this may change our marketplace?
Yeah, absolutely. So first, if I can, I just want to explain a little bit of what these increases are, because I think a lot of times when we are hearing on the news or, through social media that interest rates go up, people don't really understand what is going up. So in Canada, we have two different types of interest rates that people can get when they're getting mortgages. The first being a fixed rate. Fixed being you have an interest rate, it's set for whatever term you take for your mortgage. So that could be a 1 to 10 years term. And so the interest rate doesn't change, your payment doesn't change. And then we have what we call the variable rate mortgage. And so this is driven by something called the prime rate. And the prime rate is driven by Canada's overnight rate. So when we are hearing about interest rate announcements, that's what we're talking about. We're talking about Canada's overnight rate, and that drives that variable rate. We typically don't hear as much when fixed rates are going up. So with that variable rate, it means that when the prime rate changes, most mortgages in Canada, the interest rate, or I should say the payment, will change as well. But there are some variable rate products where the payment doesn't change. And so what ends up happening is more of your payment is going towards interest than principal. And so your amortization is extended. Now, these types of mortgages are great if you're on a fixed income, but you like the variable rate mortgage, but there is a trigger point as well. So they can only go so far. And if there's too much interest being paid, then at that point, they would change your payment. So that's the differences between the different rates. And when we get into the news of interest rates moving or rate announcements or rate hikes, it's typically that overnight rate that we're hearing about. So there are 9 scheduled times in Canada where we will get interest rate announcements by the Bank of Canada. And over COVID, over this 2 years, I will now refer to as COVID, we saw those rates go down to historical lows. And so now we're starting to see a correction of that prime rate increasing. And so the last 2 announcement dates, we have gone up. The first was 0.25%, the second was 0.5%. So now we're sitting at an overnight rate of 1%. That has made our prime rate, again, the prime rate being what drives the variable rate, 3.2%. So, it can get really kind of scary when we're seeing headlines of like interest rates are doubling because they're talking about it going from 0.5 to 1%. And it's easy to get caught up in that. But I made a post on Instagram not too long ago talking about what this actually looks like. So again, right now our prime rate is 3.2%. And so I've got some stats here over the last 20 years just to put this in perspective. In the year 2000, our prime rate was 6.75%. So, more than double what we have now. In 2005, it was 4.25%, 2010, 2.25%. And then even right before March 2020, when everything started going haywire, it was 3.95%. So really the point is that even though we're hearing rates are going up, this is standard for what happens in the economy as these rates fluctuate. This isn't out of the ordinary. And again, we had such historically low rates that now we're starting to see a correction, which essentially is a good thing overall. Now, Where we're starting to see an effect, though, on what is happening for buyers. So I'll speak to buyers because that's definitely the people I speak to most, is more around the qualifying rate. So a few years ago, stress test was a buzzword. I'm not sure if you're familiar with that term. But the stress test essentially was when the government said, okay, instead of qualifying at the rate that you're paying, so let's say your 5-year fixed mortgage was 2.5%, and you could qualify on 2.5% at that time, they had a qualifying rate introduced that also fluctuates, but basically it's a few percent higher. And so the hope is that in 5 years, when your mortgage comes up for renewal, if rates are higher, you can still afford the property that you bought at the 2.5%. So right now, the way that that stress test works is 5.25% or your contract rate, again, the rate that you're paying on your mortgage, plus 2%. So why this is affecting buyers, it's really around those who want a fixed rate, because fixed rates right now are hovering around 4%. And so what that is forcing is actually us to qualify at 4% plus 2%, which is 6%. So people who are qualifying at 5.25 just a few months ago, if they are most comfortable with the fix, it is going to reduce their max purchase price. Now, the way around this is that we qualify you at a variable rate, because variable rates are still much lower, which means we can still use the 5.25%. And then the option then would be to lock into a fixed after your mortgage closes. The downside to this, of course, is now we can't be necessarily competitive and shop around for that best rate prior, because once you're, in a mortgage already, you're sort of at the mercy of whatever they're going to offer you for that 5-year fixed at the time.
So with that stress test, when you said that, so it's 5.25% or 2% above what your rate is it just an expectation that in about 5 years' time that the rate will increase by about 2%? Is that kind of why they came up with that 2% number?
It's a very good question, Alex. There's such differing opinions on this qualifying rate in general and whether or not it's really done anything to prepare people for the future. But I would have to say, just based on what I've personally seen in fluctuation in rates, this is really just a number they've assigned, and they probably do have a reason for it. But I wouldn't want to say it's because the expectation is rates go up 2% every 5 years, because certainly even in the last 3 years, we've seen fluctuations by 2 to 3% in all directions.
And there's actually something that you had in your recent Instagram post talking about the recent increase in the interest rates and actually breaking it down, so that I do find that a lot of buyers, they see those numbers in the headlines, they kind of freak out. And it's really a lot of that mental game.
Yes.
When you broke it down, where it was, I think, maybe correct me if I'm wrong, but you said like $50 per $100,000 borrowed. So when you look at it in that perspective, it really isn't that much of an increase. Rather,
Yes.
when you see that big percentage, you're just like, what is happening? I am screwed. I can't buy a house now.
I'm so glad you brought up that point, because again, to talk numbers, I'm a numbers person. For every 100,000, when that overnight rate increases 0.25%, you're sitting at about $12. So this last increase we just had, when it went from 0.5 to 1%, you're seeing about $24 per 100,000. So you're absolutely right. And this goes into play even when you're shopping around for mortgage. This is sort of like a sidebar. Why it's so important to really look at mortgage product over rate is because, let's say, I have someone give me a call and they're like, what are you offering for a 5-year fixed? First of all, that's a whole big conversation. I never quote rates over the phone, but let's pretend I did. And I said, well, 4% will get you the best mortgage out there. And they're like, well, I see a discounted mortgage that's available for 3.89%. Well, overall, on an average size mortgage in Canada, that's costing you, I don't know, $10 a month. And at the end of the day, you're taking a much discounted mortgage for, whatever those terms are going to be not working in your in your favor. So it's really important to dig down to those numbers and see what the impact actually is before freaking out over, these sensational headlines.
Well, is there anything else that you wanted to touch on that, or maybe I can jump into some of my other questions that I have?
I think, the biggest piece of advice I would have for buyers is just to stay in touch with your mortgage broker. Make sure that you know when your rate holds are expiring. So rate holds do hold that qualifying rate in place. So for instance, I've got, some of our buyers we've been working with that we were held rates for a couple months ago. And so even though currently people are having to qualify, say at 6% for a fixed, they're still able to qualify for that 5.25. So, always super important to get those pre-approvals done and held in place and keep in contact so you know your dates and the impact it'll have on you.
For sure. And just to confirm, like for an average, or I guess a standard length of time that you can hold a rate for, is that 120 days?
It is, yeah.
Yeah, perfect.
That's right.
So it's very important to chat with you and get things rolling so that you have a timeline set in place.
Absolutely.
So first question here is, do you think that with the war in Ukraine, does that have much of an impact on Alberta and our housing market and maybe the interest rates that are to follow?
Yeah, that's a great question. The Bank of Canada actually did address the war in Ukraine specifically when they came out with this new rate increase. And really, it had to do with inflation. So, obviously, an unexpected war is going to cause uncertainty on, a global level. But there's actually a lot of raw materials that come from Ukraine and Russia. And so the increase in costs for those materials has driven inflation up all over the world. And because inflation is tied directly to these rate announcements and what happens in our economy when it comes to rates, I think that that's how it then plays back in affecting our market, right? I mean, ultimately, they increase these rates to try and bring inflation down, which again is just really to maybe decrease demand. And so their hope is that it's going to decrease demand. Whether or not we're going to see that play out in Alberta, I'm not sure. Especially because, and I'm sure you've seen this too, we've just got so many buyers from other provinces, like people in British Columbia, in Ontario, that have been priced out of their markets. I mean, we've got new home buyers coming to buy rental properties in Calgary and staying in Toronto and, not buying there. And so, maybe it's going to affect those other provinces more. I have to say that my gut feeling, and I'd actually love to hear what you'd have to say about this, Alex, but my gut feeling is our crazy market in Alberta is not going anywhere. What do you think?
I agree with you wholeheartedly. When you look at how the market was prior to COVID, we were in a recession for the past 7-ish years. And so during COVID, we actually had that recovery phase. And when you conversely look at Toronto and area and Vancouver and area, they were already in hot markets prior to, and they just continued to increase. While they're probably more likely to have more of a price burst, or whatever they call it, the bubble burst. While Alberta, we're still just in that recovery phase. You look at condos, we're still 11% below previous highs. So we still have a lot of room for improvement, especially considering we're the 4th or 5th largest city in Canada, yet our average price of a property is about 520. Like that is crazy when you look at that.
And our income is higher. Our average earnings here is higher as well.
Absolutely. And when you look at the investors from out of province that are coming here, they're all so excited to know that we don't have a land transfer tax. All of our taxes are so much less. You're only 5%. And they're just shocked with how cheap it is to buy a property. So although for us, people who live here, we're thinking, what is happening with our market? Prices are going crazy. These people are coming in thinking, this is a cheap property, I'm buying it. So I think that's why we did see a little bit of that unconditional phase. I would say about January to February, where everything seemed to be unconditional, because those out of town buyers they're used to that type of marketplace. So they were ready just to jump on in. Conversely, Now we have been seeing a little bit more of those buyers add in conditions. I think because they're just seeing their worth, they know that they should be protecting the biggest purchase that they're making. So we're
Mhm.
seeing those financing conditions, same thing for home inspection.
Oh, good. I'm actually
So
really happy to hear that. I've definitely seen more conditions coming through on my side as well.
that's good to hear because
Yeah.
I do think that we will be seeing more or our conditions stay in the offers. And I
Mhm.
think that we're not necessarily going to see another massive increase in price. However, more of a plateau and then consistent increases over time. But I
Yeah.
don't think we're going to be seeing any crashes anytime soon.
Yeah, I agree. And another question I'd love to ask you about that is, what do you think is going to happen in the condo market? Before you tell me, I'll tell you what I think.
I'd love to hear it.
I and it could be totally wrong because history over the past few years is opposite of what I'm about to say. But I personally think now is the time to invest in Calgary's condo market. I think that we're going to see a correction because people are getting priced out of other product, and we're just so far below what the market value of those condos should be.
Yeah, you took the words right out of my mouth, where again, we're 11% below previous highs. Many first time buyers, of course, want to jump right into that detached or attached product because they
Mhm.
want more space. They can then have room to grow into the home. While right now they're getting priced out of those markets. So the only place left to go that is still affordable to them is that condo market. The
Yeah,
only thing that might hold people back from getting into the condo market is the condo fees.
yeah,
So a couple of years ago, I'm sure you've also noticed when you've seen offers come through your desk, where condo fees have increased quite, excuse me, quite drastically in the past couple of years.
really have.
And
Yeah.
I don't know for certain if this is the reason why, but from what I understand, the insurance, it is a monopoly in Alberta. And so
Mhm.
insurance rates went up across the board. Therefore, condo corporations had to increase their condo fees to reflect that increase. But then
Yeah,
also with inflation for other services and whatnot too, they have
yeah.
to somehow make sure that they're not going into a deficit there. So they have to increase condo fees. So, what are your thoughts on the government's 2022 budget? It just came out and it does seem to have a large impact focusing on the housing market. So, I'm curious what your thoughts are on how much it will actually impact our housing market, but also maybe your thoughts on the new Housing Accelerator Fund, the 2-year ban on foreign residential property purchases, the doubling of the first time homebuyer tax credit, and even the tax-free first home savings account. So there's a lot to digest there. Can you maybe
Yes.
shed some light on that?
Yes, absolutely. I think that the first thing that I'd like to say is it's really hard to know what impact these are going to have, if any. I mean, and I say that carefully because when we had the introduction of the first time homebuyers incentive program, um, sorry everyone, it's pretty junky. Like there's not, I don't feel like it's done much of anything. And in fact, I've encouraged a lot of people not to take it. Anyone who would have taken it in Alberta in the last couple of years, the government is participating in these massive increases we've seen in property value. So I don't know what this impact's going to be, but what I feel is that at least they are seeing the problem and trying to come up with some solutions to address the problem. And I think the biggest problem is this barrier for people to get into housing, especially in the Vancouver, Toronto markets. In the highly populated cities, it's really hard. And even this qualifying rate that we had talked about previously, based on average incomes, something needed to be done. So yeah, so let's jump into it. We've got a few different things that they've talked about. The first is the 2-year ban on the foreign investors for residential properties. I think that this is a great thing. I think it's a little too late. This needed to be done probably 5-10 years ago. So hopefully we will see that this helps specifically the Vancouver and Toronto market. Again, I don't know that it's great for us here in Alberta because it's just pushing those buyers from Vancouver and Toronto into Calgary and Edmonton. But hopefully there will be some impact because we know statistically that there was a lot of foreign money that came in and driving prices up because they just simply didn't care about the price of anything. So hopefully that will help. So the tax-free first home savings account,
It's a mouth. That's a mouthful.
simply known as the TFFHSA. So what this is allowing is up to $8,000 per year per person, and up to a max of 40,000. So you can withdraw on that without paying tax on it for your down payment. Now, it is different than the RRSP. So there's no rebate for putting it into this account. Of course, with new home buyers with RRSPs, you can take out up to 35,000 per person, and you repay that over a 15-year period. So this is just another vehicle for people to be able to save money for their down payment, and you don't have to pay it back. So RRSP, you have to pay back. This one, you don't have to pay back.
Just to butt in on that question here, because something I've noticed, and I'm sure you have noticed as well, is that in this time frame, we are seeing the largest wealth transfer, where we're seeing those, baby boomers transition their wealth to their children, where they're giving, gifts, for example, for a down payment and whatnot.
Yeah.
Are they allowed to gift towards that type of account, or is that overall they're still allowed to do so?
Good question. I don't actually think it would be necessary.
Okay.
Because a gift, really, it's tax-free for the recipient anyhow. So they probably could put it into that account, but I don't think it would be necessary. So essentially what you could do is just maximize this TFFHSA and then still take the gift. And then we have the first time home buyers tax credit. And so right now, new home buyers, which essentially means if you've not bought a property before, but also a new home buyer could be someone who hasn't owned a property in the past. It's basically 4 to 5 calendar years. You can get a $5,000 non-refundable income tax credit, which basically works out to about $750 of a rebate. And so what they're proposing in the new budget is to double that. And so retroactive to January 1st of this year, the tax credit would be $10,000. And so hopefully that would equate to $1,400 to $1,500 rebate. The exciting first-time homebuyer incentive program I told you about, they're also extending that to March 31st, 2025. So I'd actually just really love to hear the stats on who's using that program. Yeah, so the other thing I think I would mention about that is it's basically called a shared equity program. So the government is sharing in the equity. It does not help with qualifying. So in a normal circumstance, if you increase your down payment, your qualifying amount can go up. This does not change your qualifying. It is basically just a tool to bring your monthly payments down. Then the other thing that you mentioned was the accelerated fund. So the accelerator fund is basically $4 billion they're putting out there with a goal of creating 100,000 net new housing units. So they're trying to do this over the next 5 years. And of course, the feeling about this is a supply and demand thing. They're going to increase supply. And so hopefully it will drive prices down so that, again, this affordability thing that we're talking about, it just gives us more product to sell rather than this lack of product we seem to have right now across Canada.
And so they didn't, from what I read, that they did not disclose or give any information on what type of product that they're planning on, supporting there. My assumption is that we might be seeing a lot more condominiums being built simply because there's high density. It's not as expensive as building, 1,000 single family homes. So
yes.
How will that also affect our condo market with more inventory?
Yes.
I don't know. Yeah. So that's also another kind of catch-22 here in Calgary.
Yeah. And I guess it also depends, where are these 100,000 units going to be? What's the spread? So I think that's all going to play a part. Now, again, these are all proposals by our government. So, what actually happens, I think is another thing. But either way, I personally think that, when I think about the generations coming up and their ability to buy into real estate, to me, that's, our biggest issue at this point. So anything we can do to increase affordability is super important.
Very true.
Yeah.
Well, Cheryl, thank you so much for your time. This was just an invaluable conversation. I learned so much myself, and I'm sure all the viewers will be so grateful with information. To the viewers, I do recommend following Cheryl Sanguinetti on her Instagram and social media. We'll post that below. Feel free to take a look at it because Cheryl always posts amazing information.
Oh, thanks.
And, again, thank you so much for joining, Cheryl. I appreciate it, and see you guys next time.